Hello students, today we will discuss on the cost concepts. We have understood the production function and we have understood the relevance of cost of production. So, cost of production theoretically, if we have to explain, it is the total cost of the inputs which are going into the production process. So, total cost will constitute our total fixed cost plus total variable cost. Before discussing the concepts of total fixed cost and total variable cost, let us first understand what is an economic cost. Economic cost of a product or economic cost of production. Now, economic cost constitutes of two parts. One is the implicit cost, or what we also term it as imputed cost. Imputed cost, and second category is our explicit cost. As the name suggests, implicit cost, which is coming from the word implied. So, it is an implied cost of production. Supposing a businessman is doing business from his own home, he is not paying the rent to anyone outside the business. So, that becomes an implicit cost for the factor owner, for the entrepreneur. So, implicit cost are the costs which are not paid to any factor of production outside the business, but it is the implied cost of the owner himself. And explicit cost, as its name suggests, it comes from the word expressed. So, it is expressed or given to someone outside the business. So, it is not an implied cost, but for example, if we pay the rent to someone outside the business, the owner takes the property on rent and he conducts business from that rented property. So, that rent is going outside the business, not to the owner but to the third party. So, all the costs which go to third party, for example wages, telephone, rent, electricity, all those becomes the explicit cost. So, economic cost constitutes two main parts, implicit cost and explicit cost. When we add both of these, we come to the term which is known as the economic. Concept under cost concepts is opportunity cost concept. Opportunity cost, generally it is defined as the next best alternative which is foregone for making a certain product. If we take a very simple example, all of you would be getting some pocket money. I am sure we must be getting some pocket money from our parents. Let's suppose there is a person X and this person gets a pocket money of, let's suppose, 1000 rupees per month. Okay. Now, out of this 1000 rupees, this person has to bear his personal expenses. So, personal expenses, food, travel, etc. Maybe out of this 1000 he has to pay personal expenses. Then he has some expenses for emergencies. He is keeping aside some amount for emergencies and then some amount he has kept it for his entertainment. Now, let us take from this entertainment portion, let us suppose personal expenses are 500, 300 he keeps for emergencies and entertainment he has kept 200 rupees. Now, supposing this person decides to go for a movie, or second alternative that he has, maybe he can eat out with his friends. Now, suppose this person X decides that he will go for a movie. He will not eat out, but he will watch a movie. So, the opportunity cost of movie is the cost of eating out, because that is at the cost of eating out that he is watching a movie. Another case is in case he decides to eat out. In this case, the opportunity cost is the cost which is foregone by this person, which is the cost of seeing a movie. So, opportunity cost for eating out is the cost of seeing a movie, and the opportunity cost of seeing a movie is the cost of eating out. So opportunity cost concept is the next best alternative which is foregone by the person to make or do a certain thing. Now if we talk in terms of production, the producer has, let's suppose, a certain piece of land. This piece of land can be used for setting up industry. It can also be used for farming. It can also be used for housing. So this piece of land has various alternatives. So the next best alternative which is foregone becomes the opportunity cost. So suppose this person wants to start an industry, the opportunity cost of starting the industry will be the next alternative to which this particular land piece can be utilized for. For example, farming. Maybe the person could do just farming, but now he is not doing the farming, but he is planning to set up the industry. So the opportunity cost becomes the cost of the item which is foregone. So opportunity cost means the next best alternative which is foregone to produce a certain product. I hope you are all clear with your cost concepts now. Hello students, our next concept under cost concepts is the concept of normal cost. Normal cost means, let's start with an example. Let's suppose a person has 10 lakh rupees to invest. Now this 10 lakhs is kept spare with him. If this person keeps this amount in a bank, it will earn a rate of interest of, let's say, 7% per annum. This is the return this person is getting on an investment of 10 lakh rupees. Now suppose this person decides to do business. Okay, now this person is deciding to do business with this 10 lakh rupees and he is expecting a rate of return which is also known as ROI of, let's say, at the rate of 20% per annum. So he is expecting that on a 10 lakh rupees of investment he will be getting 20% increase at the end of the year. So this becomes its rate of return in simple terms. Now supposing how do we define this normal cost now? Now when we are considering the total cost, this amount which he is foregoing to do the business. Now in this case the opportunity cost concept comes here also. The person, if he decides to do business and earn a rate of return of 20%, the next best alternative which he is foregoing is investing that money in a bank and getting a simple interest of 7% per annum. So this interest becomes this person's normal cost. So at least this amount the person should be earning by doing business. If he is not getting at least this much amount, then it is not worth for him to keep doing business. Otherwise he will just keep it in the bank and simply earn a rate of interest. So what is here is this rate of return becomes a normal rate of return and this will be a part of his total cost. So what we have here is the normal profit and this 7% is what is termed as his normal profit. So this much at least this person should be getting to motivate him to stay into business, and this normal profit becomes a part of your total cost. So this is known as normal profit or nominal cost. Normal cost is the minimum which the person is supposed to earn if he is not utilizing those funds for doing business. If he is doing business, obviously he will be getting something more than this 7%, which if he is just not doing anything, he may be getting through bank. By just keeping the money aside in a bank, he is earning a rate of interest. So this becomes his normal cost. So if we take economic cost is equal to implicit cost plus explicit cost plus normal profit. So this is an economic cost concept. That economic cost constitutes implicit cost. Implicit cost in our last lesson we understood, it is the imputed cost of the owner who provides the factor of production himself. Explicit cost, which is paid to someone outside the business in terms of money, and the normal rate of return which a person is expected to get from not doing anything. By just investing his funds, whatever return the person is getting, that becomes the normal profit. So, if we add these three, we get what we have now is the economic cost, and this economic cost is different from what we term as the normal cost or like net profit or gross profit or direct cost, indirect cost. Those are different concepts. Here what we are considering only the implicit cost, explicit cost and the normal rate of return, or what is termed as the normal profit, and this constitutes the students. We understood the various costs in economics: economic cost, implicit cost, explicit cost plus normal profit. That gives you the economic cost of production of certain goods. Now, this cost of production can be also termed as the total cost of producing certain items. So, this total cost can be subdivided into fixed cost, total fixed cost and total variable cost. Now, if we have to just understand the concept of fixed cost remains constant, irrespective of the level of output that the person is producing. For example, if a person is operating a business, he is producing a certain number of units, the cost of electricity remains the same. The cost of managerial salaries remains the same. The cost of security guards in that building remains the same. So, irrespective of the output, the fixed cost remains the same. So, they do not change with the change in output. So, fixed cost remains constant at all levels of output. Now, in case there is a zero output, let us suppose output and fixed cost. Output, let us suppose these are into units, output is into units. Fixed cost remains the same even if there is a zero output. Let us suppose fixed cost is 10 rupees per total. So, this will remain 10 in all the cases. The total fixed cost will not change, it remains the same for as many number of units that we are producing, but fixed cost remains fixed for all the number of units. So, this fixed cost will not vary according to the change in the output. Next portion of total fixed cost is the total variable cost. So, variable cost, as its name suggests, it will vary with the change in the output. So, variable cost changes with the output, Let us suppose our output is 1, 2, 3, 4, 5 units. Variable cost per unit, let us suppose the variable cost per unit is 5 rupees. So, total variable cost in case of 1 unit of output is 5 rupees. The variable cost per unit when you are producing 2 units is also 5. So, this total variable cost becomes 10. Now, as you go on increasing the output, the variable cost per unit may come down. Simple example, if you go to the market, let us suppose there is an apple vendor who is selling apples and you tell him how much per kg are the apples. So, he tells you, okay, apples are 100 rupees kg. If you tell him, okay, I need to buy 2 kgs, what will be the rate now? The seller immediately will tell you, okay, you give me 90 rupees kg. So, you can buy 2 kgs at 90 rupees, although he was selling at 100 rupees a kg. So, as you increase your output, your variable cost per unit also comes down because of certain economies of change in scale that we will do later on. So, economies of scale sink in. So, the total variable cost in this case comes down. If you are selling let us say 3 units, then the variable cost might come down to 4 rupees. So, the total cost in this case becomes 12 and not 15. If you would have taken 5 rupees per unit, the variable cost would have been 15, but in this case the variable cost has come down, so it is at 12 rupees and not the expected 15 rupees. Then if we increase the output further, let's suppose this comes to 3 rupees and then 5 units pe it comes to 2 rupees. So this will again be 12 and this will be 10. So what we observe is the variable cost per unit comes down, and that is why the total variable cost also keeps coming down. But this is only up to a certain extent. Beyond a certain level of output, the costs are going to increase, because at that point of time you need to change your scale of operations. Now what we have to note down here is that these are only cost behavior in the short run. Now short run period means the period where, not in terms of time but in terms of the factors of production. The short run period means where some of your factors are fixed and some are variable. Generally, if we take the factors of production, our land remains fixed and rest other factors of production remain variable. So that is in the short period. But in the long period, all the factors of production can be changed. So in the long run, the behavior of costs will be different. So in the short period, there will be fixed cost and variable cost. But in the long run, the fixed cost also becomes variable cost. In the long run, you can purchase more land, you can get more land and expand business. So in the long run only that will happen. But in the short run, you can put in more labor, you can put in more material and you can increase your output. So short run period means where some of your factors of production are variable, some are fixed. So the factors which are fixed only in the short period. In the long period, all costs become variable. Nothing is then fixed in the long run period. Total fixed cost remains same at all levels of output. It is a straight line which is parallel to the x-axis. Wherever output goes, the fixed cost will not change with any change in the output. The variable cost, if you are producing nothing, the variable cost will be nothing. So 0 output, 0 variable cost. So our variable cost curve goes like this. This is our total variable cost. It will keep on increasing. Per unit might come down, but as we increase the number of units, the total variable cost will keep on increasing as we increase the number of units. And the total cost, which is a total of total fixed cost plus total variable cost. So it will start from the beginning of where we have the total fixed cost. Let's suppose total fixed cost at 0 output, TC at 0 output, this will be 0 plus there will be some variable cost, let's suppose 10. So this becomes 10 becomes your total cost. So this will start and run parallel to the TVC. So this becomes our total cost. So what we see here is that total cost and total variable cost, they will be parallel to each other. Now why these two are parallel is because the difference is of total fixed cost, and total fixed cost, since it is constant, therefore this gap between total cost and total variable cost also remains the same. This will not change, this will remain the same. Please understand that total fixed cost is the difference. If we have to put total fixed cost on this side, we can say total cost minus TVC is equal to the fixed cost, and fixed cost being a constant factor over here, that is why these two curves will be parallel to each other. So the relationship, if we have to understand, total fixed cost is a straight line parallel to the x-axis. Total variable cost starts from 0, because if you are producing nothing, there is 0 cost. So we are starting from 0 and it will keep on increasing. And then once we add total fixed cost and total variable cost, it becomes total cost. So the difference between total cost and total variable cost is of fixed cost, and that fixed cost remains constant. That is why you have a parallel curve of total cost which is parallel to the total variable cost. Hello students, let us now move on to the concept of average cost. Average cost. Average cost is equal to the total cost upon the quantity at a particular level of quantity. So average cost is total cost upon quantity. If we have to find the average fixed cost, what we take is total fixed cost divided by the quantity at a particular level. We derive at the average fixed cost. Similarly, average variable cost is equal to total variable cost divided by the quantity, and we get the average variable cost. Average cost, we can also put it as average fixed cost plus average variable cost. So this gives us the average cost. Here average cost is termed as average total cost, ATC, or simply the average cost, AC. So this average fixed cost plus average variable cost also gives us average cost, and average fixed cost is total fixed cost divided by the quantity. Average variable cost is total variable cost divided by the quantity. Now if we have to depict it in the form of a diagram, what we see here is, on one side x axis we show the quantity, on y axis we show the cost. Now average fixed cost, because the quantity will keep on increasing but the total fixed cost remains the same. So the average fixed cost will be, all the time it will be coming down. So this is the average fixed cost. It is a line which is straight coming down. So average fixed cost, it will always come down because our quantity keeps on increasing, and we are dividing total fixed cost by the quantity, and if quantity keeps on increasing, the average fixed cost keeps on decreasing. So this will be, but one point to remember here is that average fixed cost will never touch the x axis, because average fixed cost can never be 0, because there will always be a total fixed cost which will be divided by the quantity. It can never become 0. So this average fixed cost will never touch the x axis. It will come down but it will not touch the x axis. The total, the average variable cost may vary initially. It may come down to some extent as you are increasing your output, and because it follows the law of diminishing returns, initially the total variable cost comes down, becomes a little constant, and then the cost starts rising. So the total variable cost, this average variable cost will be a U-shaped, like this, average variable cost. It is initially the cost will come down, become a little constant, and then the cost start rising as you increase the output, and this follows the law of diminishing returns. Initially increasing return sets in, because of that the cost comes down, but later on as you increase output, because of the diseconomies, the average variable cost will then come up. So it is a U-shaped curve, and if we have to make the curve for average cost, initially it will be also U-shaped, average total cost. What we observe here is the average variable cost and average total cost. Initially the gap between the two is higher, and later on the gap is different. Now it's reduced and it becomes less and less, but these two will not meet each other. The reason being that what we say is average fixed cost plus average variable cost is the average cost. Now we understand that average fixed cost is keeping on decreasing. So as the average fixed cost keeps on decreasing, the gap between average variable cost and average total cost also keeps on decreasing. That is why initially there is a higher gap between the two, and later the gap is reducing. So the main point to make here is the gaps between the total average cost and the average variable cost initially will be higher, but as you increase the output, this gap keeps on reducing. So this is the relationship between average total cost and average variable cost. Hello students, Let us understand all these cost concepts, fixed cost, variable cost, with the help of a table. On the first column, we are showing the output, which is in terms of units from 0 to 8. Then we have put the total fixed cost, which is constant at ₹100. So this remains the same at all levels of output. Then we have the total variable cost, which is for 0 unit there is 0 variable cost. When we produce 1 unit, the cost is 20. When we produce 2 units, it is not doubling, but it is coming down a little bit. So if we are producing 2 units, the cost, total variable cost, is not becoming 40, but it is becoming 35 only. If we produce 3 units, it is 60. If we produce 4 units, it is 100, and so on. So this cost will keep on increasing. The total variable cost keeps on increasing, the total fixed cost remains constant. Now the total cost is the total of TFC plus TVC, which gives you the total cost. So this plus this gives the total cost at all levels of output. So 100 plus 0, 100 plus 20, 100 plus 35, and so on. So total cost, what we see, it is also increasing at all levels of output. Now the average fixed cost, average is what? Average is total fixed cost divided by the units or the quantity. So when you are producing 1 unit, the fixed cost is 100, so the average fixed cost becomes 100. Similarly, for 2 units of output, the total variable fixed cost is divided by the number of units, which gives us 50, and so on. So what we observe here is that the total fixed cost keeps on decreasing. It will never increase because the quantity increases, but the total fixed cost remains the same. So the average fixed cost which is coming will always keep on decreasing. It will never increase. Then we have the average variable cost. Average variable cost is the total variable cost divided by the quantity, which is again the per unit cost. The per unit average variable cost, it is for the, in this case 20 divided by number of units, which comes to 20. Then this becomes 35 divided by 2, which is 17.5, and so on. So what we observe here is that initially, to some extent, the average variable cost decreases and it reaches a level and it starts increasing. So the shape of average variable cost is U-shaped. Initially it will come down, reach a certain level, and then it starts rising because of the advantages, disadvantages, and economies of scale. Initially the cost comes down because not all factors are fixed. Some factors are fixed, some factors are variable. So the variable factors are more in the short term. So the total variable cost keeps on increasing, but the average variable cost initially comes down, reaches a certain level, and then it starts rising. Then we come to ATC, or the average cost, which is the total fixed cost plus total variable cost divided by the quantity, or simply the average fixed cost plus average variable cost divided by the quantity. So the average fixed cost plus the average variable cost gives us the average total cost. So in this case 100 plus 20 comes 120, 50 plus 17.5, 67.5, and so on. So total this average cost is the total of average fixed cost plus average variable cost, or it can be total fixed cost plus total variable cost divided by the overall quantity. Now comes the concept of marginal cost. Marginal cost, simply stated, is the addition to the total cost by producing 1 extra unit of output. Now in this case, the total cost, in the first case when you are producing 20 the total cost is in this case 120. So from a level of 0 output, the increase in the output at number 2 level is 120. So 120 minus 100. So at this level n, total cost at n level minus total cost at n minus 1. So this minus this. So in this case it becomes 20. 120 minus 100 becomes 20. Then 135 minus 20 gives us 15. 160 minus 35 gives us 25. Then 200 minus 60 gives us 40. Then we have 245 minus 200, 45. 290 minus 245 again gives us 45. 337 minus 290 gives us 47, and again it gives 47. So marginal cost is total cost at n level minus the total cost at n minus 1 level. So what we observe here is marginal cost keeps on, it decreases initially, then it starts rising, reaches a point and it starts rising. So marginal cost is also a U-shaped curve. Initially it comes down and then it starts rising. In the next session we will be discussing on the relationship between average cost and let us now discuss the relationship between marginal cost and average cost. As we discussed earlier, average cost curve is a U-shaped curve. Initially it will come down, reaches a certain level and then it starts to rise because of the economies of scale. Then as the cost increases, there is a point where it reaches the lowest point. Now marginal cost also initially will come down and later it also starts to rise. Now in this case the marginal cost curve will cut the average cost curve from the lowest point, which is point L. So the thing to observe here is that when average cost is falling, marginal cost is below it. Marginal cost is below the average. When average is falling, marginal cost is below it. Or when average cost is rising, marginal cost is above it. When average cost is rising, marginal is above it. And marginal cost will cut average cost from its lowest point. When average is falling, marginal cost is below it. When average is rising, marginal cost is above it, and the marginal cost will cut the average cost curve from its lowest point at point L. So this is the relationship between average cost and marginal cost. Average cost, I repeat again, average cost is equal to average fixed cost plus average variable cost, or total cost divided by the quantity. That gives us the average cost. And marginal cost is the total cost at level n minus total cost n minus 1. So marginal cost is the addition to the total cost by producing one more extra unit of a certain output. So the change in the total cost because of the change in 1 unit of output gives us the marginal cost. The relationship repeated again, y side we have cost, x side we have the units. AC, average cost curve, is a U-shaped curve. Initially the cost comes down, then it starts to rise. Marginal cost also is a U-shaped curve, but it cuts the average cost curve from below. The relationship repeated again, when the average is falling, marginal cost is below it. When the average is falling, is rising, marginal cost is above it, and marginal will cut the average cost curve from its lowest point. Now let us take the case of long run, where all the factors of production are variable and we are able to change any of the factors of production. Now in this case, the long run behavior of the costs also remain the same. It's just that in the long run our cost curves become a little flatter. For example, the average cost curve becomes a little flatter in the long run. Now this long run average cost curve is made up of small short run average cost curves. Like for example, if we have to take it here like this, we will have lot of short run average cost curves, and then we will make an enveloping curve out of this, which is our long run average cost curve. So this enveloping curve is what is shown around here as the LAC. So in the short period there will be short run average cost curves, and in the long run a enveloping curve will be made, which will be reflected as the long run average cost curve, which will be flatter than the short run average cost curve. And the relationship between LAC and LMC, which is long run marginal cost, will remain the same. When average is falling, marginal is below it. When average is rising, marginal is above it, and the marginal will cut the average from its lowest point, which is the point L, and this remains constant. The relationship between short run and the long run cost curves will remain the same. This will not change. Hello students, today we will discuss the revenue concepts. Revenue means simply stating the sales, the amount by which the producer is getting by selling his produce is the revenue. Our sales is basically the revenue. Sales, or what we term in this case, is the revenue, what we are getting by selling the produce in the market. So simply stated, your total revenue is equal to price into the quantity which is sold. So this gives us the total revenue. Price into the quantity sold, price per of the product in the market multiplied by the quantity which is sold by the producer is the total revenue. Now this total revenue, it will behave differently under different market forms. In our session on market forms, where we have understood about perfect competition, imperfect competition, which comprises mainly of monopoly, monopolistic, oligopoly, duopoly and all those market forms. I hope you have revised them, because we will be requiring that knowledge to understand the behavior of revenue in different market forms. Now let us take the first case of perfect competition. Perfect competition. Let's little bit revise what is perfect competition. An imaginary situation where we are assuming that there are infinite buyers and sellers. Everyone is selling the same type of product, and no single individual buyer or seller can influence the price in the market. So the price remains the same. The factors of production are perfectly mobile. There is no advertisement costs, and everyone is free to enter and exit from the market. So those are the characteristics of a perfect competition. Now under perfect competition, since no individual seller or buyer, they can influence the price, so the price in the market remains the same. Let us take this as an example. Let us take the output in terms of units 1, 2, 3, 4 and 5 units. Let us take the price per unit. This is in rupees. Let us assume this certain thing is costing 5 rupees. This is per unit. So if a seller is trying to reduce the price by supplying more, the other sellers in the market will also start reducing the price, and it will lead to a cutthroat competition situation where nobody will then gain anything by reducing the price in the market. So under perfect competition, each seller has to sell at the price which is available in the market, because ultimately he will not gain by reducing the price, because then other sellers will also decrease the price. So whatever price is available in the market, the sellers will try to sell it at that part only. So price per unit becomes rupees 5 for these number of units. So our total revenue in this case becomes price into quantity 5, 10, 15, 20 and 25. So this becomes our total revenue, price into output at each level. Now in this case, if we have to find the average revenue is your total revenue upon the quantity, which again comes to 5. So what we observe here is the price is the same as the average revenue in this case of perfect competition. Now if we have to take out the marginal revenue is equal to marginal revenue at n number of units upon marginal revenue at n minus 1 number of units. So from the total, marginal revenue in this case is 5, then 10 minus 5, 15 minus 10, 20 minus 15 and 25 minus 20. So in case of perfect competition, what we observe is price is equal to AR is equal to MR. This is what is important to note, that under perfect competition the price, AR and MR, all three are the same. So if we have to make this in the form of a curve, this side we will take the revenue on y axis and number of units on the x axis. So this will be a straight line parallel to the x axis, where this is your price which is equal to AR, which is equal to the marginal revenue. So marginal revenue, price and average revenue are all straight parallel to the x axis, because as we have observed here, no producer will be gaining anything by reducing its price. So whatever price is available in the market, they will try to sell it at that price only. So price is equal to AR is equal to MR is the condition for perfect competition, and this is how it is depicted in terms of a graph. Hello students, let us now see the table and the graph for imperfect competition for the revenues. Now in this case it is imperfect competition. Imperfect competition can be in case of monopoly or monopolistic competition. The slant of the curve in the cases will be a little different. In case of monopoly, it will be less elastic curve. In case of monopolistic, it will be more elastic curve. Now in this case, we have shown the output from 1 to 5, the number of units. The price per unit, when we are selling 1 unit, the price is 3. When we are selling 2 units, the price is reduced a little bit to 2.5. And when we are selling 3 units, the price is reduced further to rupees 2, and so on. The total revenue in this case becomes, in first one number of unit is 3, then it becomes 2.5 into 2, which is 5, and then 3 into 2 6, 4 into 1.5 again 6, and 5 into 1 5. And the average revenue is the total revenue divided by the quantity, which again is the same as the price. So we can say AR is equal to the price. AR is the same as the price. Now what we observe here is, let us now calculate the marginal revenue. Marginal revenue is marginal revenue at n number of units minus the marginal revenue at n minus 1 number of units. So total revenue at 1 unit remains 3, marginal revenue remains 3. Now at 2 units the total revenue is 5. So total revenue 5 minus the previous total revenue, which is 3, gives us 2. So the marginal revenue in this case becomes 2. In next case 3 units pay, total revenue is 6. So 6 minus 5 becomes 1. And in 4 number of units, 6 minus 6 is then 0. And at 5 number of units, 5 minus 6, this gives us minus 1. So what we see here is the marginal keeps on decreasing. It is never increasing. So in this case, our curve will be, this is y axis mein we take the costs. In this case, we take the units. The total revenue is increasing. The total revenue keeps on increasing. What we see here is the AR is falling. AR keeps falling. This is the AR, and MR is below it. AR is falling, MR is below it, where and total is always increasing, and total is like, total revenue curve comes like this, and at this point where your total revenue is the maximum, that is the point where your MR is 0. Where your total revenue is the maximum at this level, At that point the marginal becomes 0, and beyond this point when total starts to fall, the marginal revenue becomes negative. So this relationship, please understand, when the total is following and it reaches when the total revenue is increasing and it reaches the maximum point, that is the point where your marginal revenue will become 0, because that marginal is not adding anything to the total. That is why this becomes 0 at this point of time, and that total becomes, it is at its maximum at that level, and average constantly keeps on falling. Average can never be 0. Average will never be 0, it will be coming down, but marginal revenue will become negative and it will come down. So what we understand from here is, in case of imperfect competition, in case there is monopoly or monopolistic, this will be the curve. The only difference between monopoly and monopolistic is that in case of monopoly it will be less elastic curve, and in case of monopolistic it will be a flatter curve. The AR curve in these market forms also represents our demand curve. In case of perfect competition, our AR curve was a straight line parallel to the X axis. So that showed the perfectly elastic demand curve. So that AR curves is nothing but your demand curve. And here in this case, for example, in case it is monopoly, it will be the slant will be higher, and this becomes your AR curve, and below it will be the MR curve. This is in case of monopoly. In case of monopolistic, it will be flat curve. This is the AR curve and this will be the MR curve. The point worth noting in these curves is, in these cases, like this is monopolistic, what is common to all of this is the rate of slope of marginal revenue is twice the rate of slope of average revenue in all the cases. AR curve represents your demand curve in different market forms. Marginal revenue curve will always be below the average revenue curve. AR curve being a demand curve, it follows the elasticity of demand. In under monopoly, it is less elastic demand curve, therefore the AR curve is, that slope is more. In case of monopolistic, where we have more elastic demand curve, the AR curve is a little flatter. And similarly, in case of like if we take the other market forms, imperfect, simply stating, the AR curve slopes downwards, the MR curve comes below it, and the rate of slope of MR is twice as the rate of slope of average revenue, and AR curve is nothing but your demand curve under different market forms, and total revenue will keep on increasing till a certain point, then it starts to fall because of diseconomies of scale, and when it reaches the highest point, the MR is at the point 0, where total revenue is highest, marginal revenue at that point is 0, and beyond this point the total revenue starts to fall, and this is the point after which the marginal revenue starts becoming negative. So these are the revenue forms and revenue curves along with table which is explained in this under the revenue concepts under different market forms. Now please understand, these all forms are in the short run. Long run may all factors of production being variable, we can change the scale of operations and therefore all factors become variable. So in the long run what we will have is a normal situation, not exceptional cases like the monopolistic. When he is earning a monopolistic can be earning abnormal profits also in the short or long period, because he has full control over the price and the quantity of the products, because he is the single seller. He holds the control over price and also the quantity. That is why he is able to manipulate the price also in the long run. But in the long run, in monopolistic, no single seller or buyer will be able to influence the price. in the long period. In the short period, maybe because of the differentiation of the products, monopolistic person may be earning more profits in short duration, but in the long run all the supernormal part of the profits will be wiped away and only what remains is a normal profit.